Education Academy podcast. So we are coming to you all live. Some of you all are listening to the podcast. Some of you all are watching the podcast live. If you're wondering, how do I watch the podcast live? You can go to Facebook and go to Business with Brent Simpson. You can also go to Investing Education Academy's page on YouTube and subscribe, and we will come to you live every Wednesday, 9 p.m. So for those of you all who are wondering, now you know. For everybody else who is with us, who's wondering what's going on with this topsy-turvy market, we're going to talk about that today. And for everybody, again, happy 2022. Going to say that probably we got one more time in this, and then it's just 2022. we're done with it. But for many of you all, again, you're planning for the new year. Resolutions for most of you all deal around finances, and we've gotten the phone calls, we've seen the text. A lot of people are concerned about the market and what to do with their money. So we're going to talk about that today, like what's going on in this market. And we're going to be looking at the Dow Jones in particular. And Leon can tell you why we chose it, while I do what I always do, some housekeeping.
Yeah, so we're going to cover something that a lot of people probably may or may not have heard of. It's called the Dogs of the Dow. So I'll say that again, the Dogs of the Dow. And you think about that, you might think, well, okay, when people use the term dogs, it's usually negative connotation, right? And in this instance, it kind of is, but I'll explain and you'll see why it kind of makes sense. But the dogs of the Dow are generally what it sounds like, right? So they're the stocks that didn't necessarily do the greatest that are inside the Dow Jones average, right? And so take a step back on the Dow. So the Dow is 30 stocks of the largest, kind of want to say like old time companies. They've recently added Apple, Microsoft, and something else, but they try to update it. The Dow was typically things like railroad companies, banks, kind of like old line companies that a lot of the new investors didn't really invest in. So they try to kind of upgrade it recently with some newer companies. But so the Dow is 30 companies, 30 of the largest companies in the U.S. Contrast that with the S&P 500, which is 500 of the largest companies in the U.S. So the S&P 500 gives you a more broad representation of the economy, where the Dow is just 30 stocks. But a lot of people, follow the Dow, and there are some pretty quality companies. So, so the dogs of the Dow are typically 10 stocks that didn't perform that well in the Dow Industrials last year, right? So, but it's not only the stocks that didn't perform that didn't perform the greatest. It's also the stocks that have the highest dividend yields inside the Dow. So remember, all dividend yield means it's the amount. Just think of dividend yield. Replace dividend yield with interest rates. It's how much you're going to get. The stock is going to pay you, no matter what the stock does, up, down, or doesn't move at all. When you buy it at whatever price, whatever your dividend yield is at that moment you buy it, say 3%, 4%, you're going to get 3%, 4% as long as the company continues to pay that dividend. So just replace dividend yield in your mind with interest rate that a stock pays. So dogs of the Dow are some of the lowest performing stocks in the Dow, but also the stocks in the Dow that have the highest dividend yield and or interest rate on the stock. And we're going to talk about why this can be a really good. So the reason bringing this up is because beginning of the year, market's been absolutely crazy. COVID, supply chain, and now we have the Fed on top of it, right? So it's made the market really, really crazy. And people are like, okay, what should I buy if I'm going to be buying in the new year? Brent and I have been saying for the last 2 months, buy things that benefit from rising interest rates, banks, brokerages, insurance companies, healthcare, things like that, real estate investment trusts, things like that. But that's one way to do it. But another way to do it is the dogs of the Dow. And this is another strategy. And what's kind of cool about this is actually a technique that hedge fund managers use every single year. There's some fund managers that live and die. Well, not live and die, but one of their tried and true investment strategies each year is to buy the dogs of the Dow. And we know hedge fund managers are all about making money, right? So if they do it, must have some validity to it. And we're going to show you today that buying the dogs of the Dow in the beginning of the year actually is a very good strategy. So Brent, when you get a chance, you can throw up slide 1.
Yep.
And so slide 1 is going to show how buying the dogs of the Dow over the past, I believe it's from 2008 to 2018. So it's going to show you essentially 10 years of the success or failure of the strategy. And when Brent, you get a chance.
Well, you didn't come up?
No, it didn't come up.
Right.
Yeah, there you go. All right. Could you zoom in once?
No, that's it.
That's it.
Yep.
Okay. All right. So what Brent has up on the screen here is it's a bar chart showing from 2008 to 2018, and it's showing the how the dogs of the Dow performed relative to, because remember, the dogs of the Dow are the bottom performing stocks inside the Dow Industrials index that have the highest dividend yield. So they're showing the dogs of the Dow relative to the Dow Jones index itself, the broader index itself. And so again, it's from 2008, 2018. So 2008, of course, was the credit crisis, the housing bubble, when everything blew up end of last decade. So the Dow was down about 40%, and the dogs of the Dow were down about 40%, and the Dow was down about 30%. So now we go into 2009. That year, the dogs of the Dow were up about 10%, and the S&P 500. Sorry, the Dow was the dogs of the Dow were up about. We're up about 10%, and the Dow itself was up about 12%. So the first 2 years, 2008, 2009, the dogs of the Dow underperformed. Now, from 2010 through 2018, the dogs of the Dow outperformed. Right. So I'm just looking off my screen because I have it up here. 2011, the dogs of the Dow did about 20%, and the Dow itself did about 10%. 2012, dogs of the Dow did about 10%. Dow itself did about 8%. 2013 was a huge year where the dogs of the Dow did almost about 35%.
Yeah,
35%, and the Dow itself did about 20%. Now, the interesting one to me is 2015, where the dogs of the Dow did about, let's say, 5%, and the Dow itself was negative. So the dogs of the Dow actually outperformed the broader index, which they're a part of. Then 2016, dogs of the Dow did about 20%. The Dow did about, let's say, 10%. And then 17 was a little over 20% for the dogs of the Dow, and the Dow did about 22%. So what we're showing you this is to show you that buying the dogs of the Dow at the beginning of the year can actually be a profitable endeavor and profitable investment, because over this past 10, 12 years, the dogs of the Dow typically outperform the Dow itself in the year that you buy them. So this is showing the kind of year-to-year breakdown. Brandon, you can pull up slide 2. So slide 2 is showing us here. What this is showing us is basically over that 10-year period, the actual increase of the dogs of the Dow relative to the Dow itself. So from 2000, this is 2007 to
7
to 2018. The Dow did about, let's say, 60% return, but the dogs of the Dow did over 200%, did about 210%.
Mm-hmm.
So again, over a 10-year period, the dogs of the Dow have outperformed the Dow itself, showing what we're showing here. And then we showed in the previous slide, showed the year-to-year returns of the dogs of the Dow versus the Dow. The dogs of the Dow typically outperform the Dow itself. So if you're wondering what to buy going into the new, and this happens in the beginning of the year, right? So what fund managers do, they buy the dogs of the Dow in January and then hold it for the rest. What they do is they put in a set amount. So let's say they took, I don't know, $100, or $1,000 per, there's usually 10 of them. So they take, $1,000, put in each one. So $10,000, invest in the dogs of the Dow. And then they track that return at the end of the year and see how it performed relative to the Dow itself. Again, as we're showing here on the screen, over a 10-year period, the dogs of the Dow pretty much greatly outperformed the Dow itself. You're looking at over 200% return over 10 years versus a little over 150% for the Dow itself. So if you're looking for something to buy, the dogs of the Dow are a very good investment. And here's another reason. So one, they've showed they outperform, and two, they have high dividend yields, right? So let me just pull the stats. So I ran the numbers. So the average right now for the dogs of the Dow for 2020.
And Leon, real quick before you go into that, for anybody that doesn't know what dividend is, and some people watching, they don't know before we dive into the yield. Dividends are the amounts that companies pay back to the shareholders in the form of a payment. Normally it comes out per quarter based off of some annualized number, which is, I believe, what Leon's about to give us.
Yeah. So it's just like I said, it's just how much you're going to get. Typically, as Brent said, quarterly, 4 times a year. You're going to get a certain amount of money that the company's going to pay you
per share.
So per share, yes, per share. So, and like I say, just think of it as the interest rate the stock is going to pay you over the year. So this is an annualized number. So the average dividend yield for the dogs of the Dow for 2022 is 3.9%. The highest one, the highest dividend yield in the dogs of the Dow is 4.94%, so almost 5%, and the lowest is 2.70%. So not only would you be buying large cap companies. We're talking companies that are like, have market caps over like $50 billion. They've been around for like 100 years. They're not going anywhere. Most of them, well, all of them pay dividends, and all of them pay pretty high dividends. So you're looking what we've been saying with this whole Fed thing is you want to get away from buying the really non-profitable speculative tech companies that a lot of us fell in love with the past 2 years. Those are going to struggle going into the next couple of years as the Fed raises interest rates. The dogs of the Dow type companies are exactly what you want to buy. You want to buy stability, you want to buy profitability, and you want to buy ones that pay dividends. So the dogs of the Dow are a great purchase, beginning of the year, if you're looking to spend some money around this year. So
and
again,
real quick, and for anybody listening, we're not giving you direct advice, and you have to make sure that it's a good decision if it matches your portfolio and how you want to invest. But it's something to definitely consider. I think that's when we say you definitely want to own it, is we definitely want to consider it.
Yes, you definitely want to consider that. Yeah. You definitely want to consider these as you're on your watch list, or however you do your stock analysis. Yes. But dogs of the Dow are a good option to look at if you're looking to buy stocks. So that's pretty much it. Let me add anything else. That's it. Yeah. So dogs of the Dow. If you don't, what we're gonna do for inside the membership community, we're actually gonna publish what the 10 dogs of the Dow for 2022 are, and we're gonna publish that along with their actual dividend yields for this year, or at least right now, what they are right now inside our membership community. So our IA members can look out for that tomorrow at some point.
Yeah, and if you have questions about it, post it in the group. Once we have it listed and you have questions about anything that you see, post the questions and we'll try our best to get to it. But, it's a lot of members in the community that love to chime in. So, when you get this information, be it from us or whomever else, compare it to what you desire, what you wanted for your portfolio. And right now, the environment is changing. This stock environment, we're talking about high interest rate environment that's going to affect some companies on the positive side, some on the negative side, but overall it will change your portfolio and how you allocate funds inside your portfolio if you care. Some of you all might not care, and some of you all might be like, I bought buy and hold, I'm not looking at it. We suggest you do look at it and you give it some real consideration in this environment, but at the end of the day, it's your money, and it's for us to inform you as best we can. And for our members, spend some time. Again, I'm I'm begging you, spend some time in those topics. There is gold in those hills. So
and then there are hills.
I was gonna say it. I was like, I'll make it halfway. But there really is. There's a lot of gold in there. I mean, even for myself, so many ideas that I've had, Leon had, other members have had, I've gone back and looked at it and realized like it still makes a lot of sense today. So I kind of use it as a collection of information to help me start my research process. So tomorrow, or if it's tomorrow, which is Thursday, or Friday, when we put that list of the dogs of the Dow into the platform, read it, spend some time with it, see if it makes sense for you. So with that being said, Leon, are we missing anything?
I just want to make one other point. That today, we may talk about this next week. I don't know. We may not, but there's just again, information. So today, the Bureau of Labor Statistics put out what's called the CPI, or the Consumer Price Index. It came out today that inflation over the last 12 months is up by 7%. 7%. So that means that whatever money you have sitting around in a savings account or anything that was interest bearing, that's earning like 0.05%, way less than 1%, you just lost 7% of your buying power on that money. 7%. So if you had $5,000 sitting in a savings account over the last year, that $5,000 today can only buy about $4,600 worth of goods. So you lost like $350, $400 worth of buying power on that $5,000 sitting in that savings account. Inflation is up 7% over the last 12 months. That's what we gotta have our money in assets that beat inflation. Stock market, crypto market, real estate, entrepreneurship, something. Your investment dollars should not be sitting in a vehicle that's actually losing you money per day and per year.
Yeah, agreed. So for everybody, we will be putting our stock picks into the Facebook group. So if you're looking for the Facebook group, just go to Facebook, type in Investing Education Academy. We will pop up. If you are a member, our second stock pick, actually both stock picks will be listed inside of our membership platform, and just go to the iamembers.com, log in, and you'll be able to see our picks. We definitely want to thank you all. We want to get the year started right. So if you have questions, we had a fantastic Ask an Expert on Saturday. It was definitely phenomenal. And truthfully, even our Bulls meetings all the meetings have been great so far. And we just found out that there is something happening in the NFT space, and the IEA Crypto Bulls are on the wait list for it. I don't know if you are, but it's pretty big, and we are high up in the line, considering I think it's like 1 million people per day that are signing up for this thing. So hope you're part of it. So with that being said, it's a pleasure being with us. Turn your dollars into employees. We will see you next week, next Wednesday, 9:00, same time. And you can always check out our podcast at www.ieapodcast.com.